Hi everyone, Mike here from the Business Experts. We just wanted to give our clients an update on the federal budget that was released last week. So there was a lot in it. It was a big spending budget, but we've pretty much boiled it down into this quick video to take you through what we think is the most relevant for our clients. So we hope you get some value from it. Okay, so just a snapshot to sort of set the picture of how the budget's looking. For this financial year, the government's predicting that the budget will actually blow out, so it'll be a deficit or a loss of over $200 billion. Worth noting though, $100 billion of that is due to the JobKeeper scheme, which has been a big saviour for a lot of small businesses. In terms of the debt, so debt's actually forecast to blow out to over $700 billion this financial year, which is just phenomenal. And the scariest part is by 2024, we're possibly looking at the debt reaching almost $1 trillion, so 966 billion forecast, which is over 40% of the GDP. So it's a lot of money. But just to put that into perspective, out of that sort of 966 billion, over 500 billion of that has been measures in response to COVID. So obviously we're in recession. The government's trying to restart the economy, kickstart it and get everyone back into jobs and spending money on infrastructure. So that's really what this budget's about. So there's a few key changes I want to take you through, and I sort of boiled them down to this list. So the first one is there's some income tax cuts that are starting or backdated to the 1st of July this financial year. There's introduction of the company loss carryback rules. There's some changes to the depreciation rules, which are quite exciting. So there's some good tax opportunities there in terms of expensing assets. There's some changes to the small business concessions. So they're basically making that available to businesses with higher turnovers. There's introduction of the job maker hiring scheme, which is quite exciting for small business as well. And there's the continuation of the apprentice subsidy, and there's some minor changes to superannuation. So the income tax cuts, so what I've done there, you'll see in the email, there's a link to click on the Ready Reckoner, which actually will tell you how much tax you will save based on this latest budget change. So you can see on the screen there, pretty much anyone earning 0 to 18,200, there's no changes, that's tax-free, still the case. But for someone earning between 18,000 to 37,000, you'd normally pay 19% tax on every dollar earned over 18,200. So they've just widened that bracket now. So rather than 37, they've pushed it out to 45,000 at the 19%. And you can see the $90,000 bracket, they've moved to $120,000 bracket. So have a look at the tax Ready Reckoner there to see how much tax you'll save. You basically just look up your income in the left-hand column and it'll tell you compared to last year and this year how much tax you're going to save. So for most people, it's over $1,080, which is a bonus. So this measure unfortunately only applies to companies, so it doesn't apply to trusts, partnerships or sole traders. So ordinarily when a company makes a loss, that loss is carried forward and must be offset against or can be offset against future profits. So the government's actually flipped that on the head and they've said, well, if you make a loss in the 20 financial year, 21 or 22, there's an opportunity to carry that loss backwards and offset it against profits that you made in the 19 year. So in other words, you can claim back some of the tax on the profits you paid in the 19 financial year, which you ordinarily couldn't do. So only catch to that is you have to actually wait until you lodge your 2021 company tax return before you can make this claim. But a loss incurred in the last financial year, 2020, is eligible to be claimed. So probably the best way to explain is just with a quick example. So we've got a hypothetical company here. It's made $2 million profit. At 27.5% company tax rate, it's paid $550,000. So ordinarily that money's gone. You've got no opportunity to get it back from the ATO. But under this measure here, they incur a loss in the 20 year and 21 year. So you can see there in the 20 year, they make a $500,000 loss. So because we can't claim that back until the 2021 year, nothing actually happens. So last year's tax return, business as usual, we've got that $500,000 loss carried forward. But in the 2021 financial year, so June next year when we do the company return, the company's got another loss of 100,000. So suddenly we've got 500 from the 20 year as a loss, and we've got 100,000 from the 2021 financial year. So we've got $600,000 in losses to claim. So what we can actually do is we can take that 600,000 in loss, carry it back to the 19 financial year, and we can actually take that off the profit. So we didn't make $2 million profit in the 18-19 financial year. We only made $1.4 million profit. So the tax is adjusted. So basically you can see at the bottom there, the tax office would owe the company a refund of $165,000. So this is a great measure. It's government realising that you might have paid tax in the 19 financial year. Since COVID, you probably incurred some losses. It's an opportunity to get some money back June next year. So this measure here is to do with depreciating assets. So from the 6th of October applying up to 30 June 2022, if you buy an eligible depreciating asset, you'll be able to expense that in the year you purchase it. So ordinarily it'd have to be depreciated and spread out over a few years. Under this measure, you're able to purchase an asset and claim it instantly off your profit, which helps reduce your tax. So provided your turnover is under 50 million, it can be a new or second-hand asset. So there's no value on it, so you can buy a piece of plant and equipment or a motor vehicle and then claim it straight off the profit. Just one thing with the motor vehicles though, the depreciation car limit would still apply. So if you purchased the car for 100,000, unfortunately you only be able to claim roughly 58,000 of it because of that depreciation cap. But if you bought a commercial vehicle or a truck, for example, and that truck cost $250,000, if your turnover was under 50 mil, it was second hand or new, you'd be able to claim that as an instant deduction. One important point to realise too, so if you're a small business, so your turnover is less than $10 million, and you had purchased depreciation or depreciating assets prior to this announcement, so let's say you purchased a vehicle or a truck or a machine for $200,000 a year ago, and that was being depreciated under the existing rules. Well, under this new rule, if at the end of the financial year, so we're talking 30 June next year, you can actually deduct the whole balance, so you can write that off as well. So you're not missing out on that. So this is actually really huge. It's going to save a lot of clients and taxpayers a lot of money. Just on the small business concessions, so one of the budget measures was just to increase the access to those. So they've looking at basically phasing in businesses with a turnover of 50 million will now have access to some of the concessions. I'm not going to go through them, but what I do want to just have a quick look at or mention, why do you want to be a small business? Well, one of the really attractive ones is there's only a 2-year amendment period with the ATO. So basically, if you lodge a tax return and there's been no fraud or evasion, you've pretty much got peace of mind that after 2 years, the ATO can't audit you and they can't amend your tax returns. Ordinarily, that would be 4 years. So it just adds that peace of mind that after 2 years, you're all clear. Now, this one, the JobMaker hiring credit, this is sort of, to me, showing us that JobKeeper, which it was extended to March next year, that's definitely going to finish, because this is obviously it's the concept or its replacement. So JobMaker starts from the 7th of October and will apply for 12 months. And the idea there is it's about getting people back to work. So if you're an eligible small business, or actually any business other than a few exclusions like the banks, the concept is if you hire someone between 16 to 29, and that person has been in receipt of an income support payment such as job seeker or youth allowance for at least one of the 3 months before they're hired, you're actually eligible to claim a credit from the ATO of $200 per week, which is paid quarterly. Now, if you hire someone 30 to 35, that's reduced to $100 a week. So it's very similar to the JobKeeper program. You claim it in arrears from the ATO by making a declaration each quarter in this case, and then they'll reimburse you those wages. So a few criteria. Number one is you must actually show, as at the 30th of September, that your headcount has increased. So it's not about replacing positions, it's about creating new positions. And you must show that your payroll has basically increased over the 3 months prior to the 30th of September. And the other thing is that you must demonstrate that the employee has worked on average at least 20 hours per week for the quarter to get the rebate. So what do you do about it? Registrations apparently are going to open on the 7th of December with the ATO, should say 2020 there. So we'll keep you posted once we know more about that. This one, just a quick mention, for any of our small business clients that have claimed back the Victorian state government grants, there's been 3 payments so far of roughly $10,000. The latest one that opened, which they're calling the 3rd round, that's targeted to the industries most affected by the COVID stage 4 lockdown. The government has announced that they're going to amend the tax laws and make that $10,000 payment tax-free. So don't know if anyone's aware, but the other payments you received are still income. Whilst they didn't have GST, so they're GST-free, you do have to still declare them as income. In this particular case, the 3rd payment or 3rd round grant that you're going to receive or might be eligible to claim, that will be tax-free. So under this proposal, from the 5th of October until the 30th of September 2021, any size business will be eligible to claim a subsidy payment for an apprentice or trainee. So the concept there is if you put on an apprentice or they recommence with you or a trainee, the government will allow you every quarter to claim back 50% of their wages as a refundable payment. Capped at $7,000 per quarter, and the places are limited to 100,000. So it's great. So all about getting people back to work again and creating new positions. So if you're looking to hire any apprentice or trainee, I encourage you to look into that program. So there's superannuation changes. So government's committed a bit of money there, $160 million, towards some reforms and improving the way super works with employees and employers. So one of the biggest problems at the moment is an employee quite often will have several super funds, and the reason for that is they start a new job, their employer sets up super for them, pays into that fund, that employer leaves that employer, goes somewhere else, that new employer sets up another super fund, starts contributing to that. A few years later, that employee's got 5 super funds which they're paying fees on and we're paying insurance on, and it's just silly. So the idea here is that if you start with an employer, that you will be able to actually staple your super fund to that employer and to yourself, so that if you move employment, so you start with a new employer, there'll be a tool available where the new employer can look you up and see, okay, that is the super fund that I'll be contributing to. So it avoids you opening up unnecessary funds. The other measures that they're going to do there is they're going to create a tool that will allow you to basically look at the various super funds on a number of criteria and help you choose which one's in your best interest, so simplifying that selection process. And they're also going to sort of target those underperforming funds. So they're going to start to put more pressure on the super funds in terms of their fees and their performances. So they're going to basically benchmark the funds. So APRA, as the regulatory body, is going to look at each fund and have a benchmark that they have to exceed. And if they don't, they'll be held accountable to it. So these are all positive changes for the super industry. So that pretty much concludes the key budget changes. Obviously it was a big spending budget in response to COVID and the fact that we're in recession. So what we boiled it down to was the key facts and changes that we think are relevant for you guys as our clients. So of course, if you have any questions, please feel free to reach out and ask us. Always here to help. And just an update, our office is still closed, so we're still not permitted to open the office. Hopefully in the next month we'll be able to. And I'd just like to say to everyone, take care, stay well, and we'll see you next time. Thank you.